Good day, everyone. Well, before I get into what's going on with the Fed, since the 1980s, we get lower highs and lower lows in interest rates as measured by the federal funds rate, as you can see in the chart. And this is a basically very long term showing how basically we're getting a attenuation of how far these rates can bounce rather. And so this has led those such as Ray Dalio to speculate that we're nearing the end of the 75-year debt cycle. That's what he calls it, which is roughly 75 years, give or take 25 years. And Dalio has studied cycles going back several hundred years. When this long-term debt cycle comes to an end, revolution and war typically break out, as hyperinflation from excessive money printing is often one of the catalysts. Interest rates can only go so low before the system destabilizes. The fiat of the winning country then enjoys world reserve currency status. The US dollar achieved this at the end of World War II. If we expand this back out to 1790, and that's the next slide, we see that inflationary periods were caused by war. So you have COVID-19, which could be considered a war of sorts. And in other periods since 1900, interest rates were sufficiently high enough for the Fed to lower rates to spur economic growth, such as in June of 1932, when the Fed aggressively started to lower rates, spurring the largest bull market in the history of the Dow Jones Industrial Averages, where it doubled in price over the next several months. And we also have the Vietnam War in the 1960s. Then we got also the oil embargo of the 70s, and that spurred inflation. But interest rates were pushed to record high levels by the Fed chair Volcker at the time, by the late 70s, early 80s. So he had much room to reduce rates to spur the economy. Now, in today's market, interest rates are near the floor, while inflation is soaring and debt is at record levels. And this suggests a major tipping point of change is coming. The Fed can keep raising rates, but this will kill the debt markets and will spawn bankruptcies galore. And it'll make the 1930s look tame. When the Fed hiked by 75 bips at its last meeting on June 15th, debt increased by nearly $1 trillion, and that shrunk GDP by negative 3.8%. If they hike another 75 bips, that'll put the effective Fed funds rate at 225 to 250 bips. And if they do that when they meet on July 27th, debt will increase by over $1 trillion and shrink GDP by 4.7%. They simply can't keep hiking rates to their target range of mid 300 BPS from where the Fed funds currently stands at 150 to 175. The rate of 10-year treasuries is also not sustainable. That's the next slide. And if we go back to the early 1980s, the 10-year is way above its downtrending line because the Fed has aggressively hiked rates with the expectation that they will continue to do so. But instead, they're eventually going to find a reason to launch the next iteration of QE, which will reverse whatever rate hikes they make. Eventually, this will send rates back to 0%. This will also allow inflation to run high because this reduces debt while debasing the US dollar. And meanwhile, the real CPI will continue to be covered up by the fake CPI, which exaggerates GDP. Some have suggested 50-year and even 100-year bonds are in the offing. They would act as inflationary buffers as dollars flow into an instrument where it doesn't move for a long period of time. Homeowners would have lower monthly mortgages, making inflation more affordable. But this is like putting a bandage over a tumor. Exponentially growing technologies, what I call expo tech, such as AI and blockchain, will materially contribute to wealth creation and so will contribute to real GDP growth. Quite the opposite of QE. Decentralized and permissionless networks such as DAOs will have their own tokenized ecosystems. Layers of middlemen, i.e. the rent takers, are removed. The future is a world driven primarily by digital tokens where the US dollar is no longer the world's reserve currency. These digital tokens can exist within other financial ecosystems such as Ethereum, while digital currencies and commodities such as Bitcoin can coexist with these other ecosystems. As more of the world's value becomes digital, countries and businesses will put more of their value on digital currencies and tokens. Now, the CPI number came in hot as it did last month, as the dead bat rolls over once again, or at least it it's attempting to. If market action rhymes with the prior month's hot CPI number, then stocks and crypto will tank over the next few trading days before becoming oversold, then initiate a dead bat bounce once again. But I also, we were talking before the broadcast, there could be some short covering in here because the report's is so negative, and while last month everything fell apart over 3 days, markets rarely repeat and make it that easy. So I think there's a lot of people with short positions on that could get liquidated if we see some sort of attempt there. We'll have to wait and see, but my view is the higher we go here, the more shortable everything is, because I just can't see the markets off to the races. It's unprecedented. It would be completely absurd. I know the market is anticipating when is the Fed going to halt rate hikes, but they're in a worse position now because inflation is out of control and they've got to raise. And now the CME futures is pricing in much higher probability that at the end of July, when they meet, they're going to have to hike by 100 basis points. Not good. And the so-called market in uptrend called by IBD on June 24th, when the NASDAQ composite had a sufficient gain on a higher volume day, was met with a distribution day 2 days later. And if a distribution day occurs within 2 trading days of when IBD switches to market in uptrend, the call is far more likely to fail. So that's where that call is at right now. And the big buy signal comes when Powell halts or reverses hikes. Until then, I remain on the defensive side. I'm certainly not long anything. I have some short positions on an ETFs as per the market direction model, and also in cryptocurrencies. And it's just a question of if I want to press my advantage, and I think I would if we start to roll over in a definitive way. The Fed's likely to halt the hikes once unemployment moves higher by at least 2%, or the S&P 500 has tanked somewhere between 40 to 50% off peak. And halting may be equivalent to their halt of hikes in January 2016, when stocks and crypto started to trade in a mildly higher uptrend all year. And the big bull in stocks and in crypto didn't start until late 2016 for crypto and early 2017 for stocks. Hike halting also occurred in July of 2006 and January 2019, after which markets also had mild uptrends. Certainly shifting from halting to QE5, on the other hand, would be a very bullish event, but that may be a year off due to the long tail of persistent inflation. The Fed's mandate is full employment and stable prices. And because of this, some say a recession is no reason the Fed would stop hiking rates. But because the Fed and higher-ups have big holdings in stocks, bonds, and real estate, Powell will find a reason to halt, then reverse hikes if several hundred years of history is any guide. The Fed has never hiked rates in a recession, and the soaring inventory to sales ratio would offer such a reason in the coming months, as retail prices would then plummet, allowing the CPI to moderate or even fall. In the meantime, material gains can be made from those in stocks in cryptocurrencies that show fundamental and technical leadership, and these would be the ones that are one of a kind. This is very, very rare, but they do occur. And I don't expect them to occur now, but I expect them to occur once the market sort of starts to trade sideways to maybe stabilizes. But I mean, I think that we're a few months off from seeing any rare stock or cryptocurrency that can exhibit this kind of leadership. But to sum up, markets have been crushed as economies die. Consumer confidence is at an all-time low. The record levels of debt cannot handle higher rates of interest. Rates peaked at 3.2% in 2018 when there was $9 trillion less debt. For the Fed to target 3.8% by 2023 is a pipe dream. Rates have never been raised in a recession, as I've said, and a most serious one is staring everyone in the eye. The Fed will continue to hike, delaying the halt or reversal of rate hikes if they want the Democrats to fail during midterm elections this November. And this would push markets even lower and GDP even more negative. Caveat emptor. Gil, how are you seeing everything?
Well, I think you summed everything up pretty well. And if we look at the indexes, basically what you're looking at is, okay, we're moving back to the upside after the buy the news on the CPI. So, and I think also there is hope that the economy is coming to a crashing or screeching halt, probably more a crashing halt, and the Fed is going to have to turn around and start lowering rates. And as Chris said, that's probably what they want to do. But for now, what you're looking at really is just kind of a descending base here. You're a descending trend channel. And so you're just flopping around between the lows and the highs of this trend channel with no real decisive resolution either through the top or through the bottom. And I think you could have either depending on how this plays out. So short term, yeah, you got to rally off the lows, kind of was being expected. But some other interesting things going on is they've got, you can see the TNX is coming in. So the TNX is obviously thinking that interest rates are coming down one way or another here, and we'll see whether this turns back to the upside. So I keep an eye on the TNX, but I don't really see why you need to stick your neck out here either way, really. You can hang back and see how far this rally goes. Or you could look at some things, like I noticed if we look at the, whoop, that's the wrong chart. Let's go back here. You look at the GLD, for example, and I'm actually going to use the PHYS, which is what I prefer. And you can see that you have this low from October 2021. That's at 1356. So you basically posted an undercut and rally through there today. So theoretically, that could be something you might look at buying here with the idea of using the 1356 prior low, or is it, I think it's 13. Let me check that. One second. I actually wouldn't be surprised if this market rolled over after this little rally. I don't. This is very tough. Let's see. So I'm trying to find that low. So that was PHYS. That low is at 1356. So I was right. So you're at 1363 right now. So theoretically, that is an undercut and rally long entry. You would use 1356 as a selling guide. So that's one thing you could look at. Whether that works or not is another issue altogether. Even silver, the PSLV is following the PHYS, but there's really no reference points on this chart until you get out to the, see, now you're starting to come back a little bit. This is really tricky. That's like why I said, I'm just watching things trade around, that it's very tough to stick your neck out. So, but you've come all the way down on top of this area of congestion from 2020 and late 2019. So possibly, if gold continues to rally, so if the 1356 October low in the PHS holds up, then you're looking at potentially silver will push higher. Of course, silver is weighed down by the fact that half of its use is industrial, and we'll just have to see how that plays out. But very tricky right now. And that you could go to some of the gold stocks, and I need to update this actually. But if we look at the group, which I will do here, this is one of my favorites, and this is actually moving pretty nicely today. So you may be getting a pocket pivot coming up through the 20-day line here. So that's a possibility. If you look at First Majestic Silver, you may be looking at a pocket pivot developing along the 10-day line here. You also have an undercut and rally coming up through this low here. See if I can get my data window to work. So the low here is 724. You're coming up through 732. So you actually do have that in play, okay? And those are two of my favorite names, AG, First Majestic on the silver side, Goldfields, GFI, the third largest producer of gold in the world on the gold side. And then you have a bunch of other, say, also RANs like Anglo Gold Ashanti, which is another big gold producer. Agnico Eagle Mines. Some of these are way down there, but I think, you know, if I'm just focusing on these two, which actually are my favorites, Goldfields and First Majestic, they're actually doing pretty well, and that's where I would stay. So if you wanted to try these now, I guess the 10-day line would serve as a tight selling guide, or that prior low, which is that 724, is that right? Yeah, so you're 720, so you're it's pretty close. It could go either way. And then GFI, Goldfields, they just bought Yamana Gold as well. You got an undercut and rally through this low at 929, so that's 30 cents ago. You just cleared the 20-day line, so potentially a long entry there. And of course, this all presumes that this is going to hold up. And I got to say, I'm not entirely convinced. Like Chris, I've never seen a bull market start while the Fed was in a tightening cycle. And
Right.
going into a recession as well at the same time. So none of it really makes any sense. So I think that's what that's what you're faced with. It's a market that may not make sense. So you kind of have to be ready for anything. But I mean, some of these golds and silvers this morning have been good trades off the lows. But it's hard to believe the moves. All you do is go with the setups. Okay. And if you can define a selling guide, then you just get ready to pull the ripcord if it doesn't work out. But otherwise, it's a little bit of seat of the pants. Well, not a little bit. It's quite a bit of seat of the pants stuff. But it's definitely fascinating to watch here. So, I don't know exactly what's going to transpire as the day wears on. So it's kind of crazy. So. Anyways,
yeah, I can't even find a nugget of good news in the CPI report. I'm always looking for, okay, well, is there something I missed? And I'm not seeing it. I just really bleak. Everything's really bleak.
yeah.
I think there was a talk that there was so much selling going on over the last few weeks that the selling is exhausted, but I'm not seeing evidence of that just yet. I think that sentiment and like if you look at the put to call ratio and everything is not so oversold. And I mean, if you look at the market action of the Nasdaq and S&P, it's been kind of bumping up and down. This is a classic dead bat bounce to me.
Dead bat. I like it. Why do you call it a dead bat?
Yeah, I was thinking, COVID and all, and then
okay.
I like the alliteration of bat bounce. So
all right.
into my head.
Okay, so now we have that 724 UNR level on AG, and it's starting to fail. Okay. So for these, if you're trying to catch these, you had to be like thinking, okay, they're going to start thinking rates are going to come down, and maybe I get a pop. So you have to buy it off the MACD turn, which would have been somewhere around 675, 685, somewhere in there, and then cross your fingers, and that's basically what you're dealing with. So for trend followers, I think a lot of it is just staying on the sideline and staying in cash, and then if you're a rapid fire day trader, swing trader like I'm trying to be right now, you can go for that. But I got to tell you, today's a rough day in terms of like trying to get a handle on what's going on. I started up like 3, 4, 5% this morning, and now I'm basically up 0.5% right now, and I'm just running some small stuff. But it's just very tough. But I wouldn't be surprised if you roll over. So and as I'm speaking here, let's take a look at a few things. UVXY is trying to turn off the lows, so you'd want to watch this. This looks interesting here. You have the MACD has flattened out a little bit, so you'd watch for a turn here. It looks like it's trying to come up off the lows. The SQQQ, I think, is doing the same thing. They'll tend to correlate, but you can watch these. The MACDs have not crossed yet, but you're getting into a position where the market looks like it may be running out of steam here. A big short covering rally. So why is the dollar dropping? Because interest rates coming down. If the market's trying to anticipate that the Fed is now going with CPI as high as it was today, now the Fed's going to come in. I was even wondering, and I was going to get your feedback on this, Chris. You think you could see a 1% emergency rate hike?
Wow. I mean, that would be so upsetting to the markets. I don't think we're going to see that. I think the odds are low. But I mean, yeah, I think the CPI number would have had to come in even hotter than it did for that to happen. I mean,
yeah.
we're 9.1 versus 8.8, and then on the core, it was 5.7 versus I think 5.5. So we're a bit higher. It's kind of like a repeat of last month where everything came in a bit hot.
Yeah.
But the market just gave it up. I mean, over 3 or 4 days, it was just straight down. And I think now markets are trying to find when the Fed is going to halt the hikes, but it just logically they this pushes out their ability to halt further because inflation is a bit out of control. I mean, it tends to run hot for a while.
Yeah.
And I mean, certainly the Fed funds futures are indicative of, saying that they might have to hike by 100 basis points when they meet in July 27th, when they conclude their meeting. Let's see. Yeah. July 27th. That's a Wednesday. So that's 2 weeks away. And I would think that things are not going to be, though I don't see the markets rallying over the next 2 weeks. It doesn't make any sense.
No, but who knows? Maybe it will just continue to not make any sense whatsoever. Because, I mean, you're in bizarre times. These are bizarre times. You've never seen anything like this. Also, to answer your question about the dollar, I think you got a little bit of the sell the news here. And, of course, the assumption that the Fed is going to have to reverse course sooner than later after an extended run in the dollar, as you can see on the UUP here. I think rates are coming in a little bit. TNX at 2.94. It's down a bip, 1.7 bips. So really not much of a breakdown. So I don't know. I don't know if the market's really convinced here. We could actually break to the downside and make lower lows. I certainly wouldn't discount that. First, you got to run in all the shorts, so I think it makes sense for the dollar to be pulling back here on that basis. But we'll see whether this holds up. Also, a lot of the dollar's rally has been due to the fact that the currencies against which the dollar index is measured, the yen and the euro, have all been falling like rocks. So, I mean, are we at parity right now on the euro dollar?
Yeah, we're 1.01. I mean, the euro's trying to rally mildly here, but we went all the way down to parity the other day. And I think we're going to break parity at this rate because they have to keep hiking, so the dollar is going to get stronger. And I mean, certainly the trend in the dollar is up, fiercely up. But when the dollar gets overheated, then it needs to back and fill because no trend goes up in a straight line. And I think that's what we're going to see is maybe some backing filling. And I mean that's what it seems like to me. Also on the major averages is that the averages got hit really hard at 8:30 a.m. Eastern Standard Time with the CPI news, and now they're just kind of trying to claw their way back. When you look at a chart like a daily chart of the Nasdaq, there's a lot of backing and filling even on an intraday level. So it never goes straight down. It just kind of goes down, up, down, up, down, up, down, and as the downtrend takes form.
It's wild.
It is.
So, so there's a big picture right there on the Nasdaq. You're basically in a downtrend channel. I don't know where people get this idea that you're in a confirmed uptrend because there's no leadership. I'm actually surprised they put that out, but that just tells you that since News Corp bought IBD, they don't really consult with Bill. He's not around anymore. I don't think Mike Webster left, and there's nobody there really, because we know, you and I, Chris, know that it all boils down to the setups. I mean, stocks are generally, and you even get an inkling of this before the market turns in a bear market off the lows of a bear market, is that things will start to set up. And you'll see constructive bases. You'll see stocks either rounding out the lows of bases, trying to come up the right side in some cases. But you don't see any of that really right now. It's just a lot of chop and slop, a lot of garbage rallying one day and then tanking the next, and so on. But if we, let's see, I've got my HCS Investor updated. So you can see my projected volume is going to be this green bar here. So that's projected volume. We're actually starting to turn a little more. I actually did trigger along on the UVXY at 1350. So we'll see. I'm not getting too excited yet. Maybe that's a good thing. But you can see all of these, there's huge volume in them. And you can see, just focus on this little green bar. That's showing projected volume based on what's trading right now. That doesn't mean that's going to hold up all day. Okay, it can suddenly just disintegrate or dissolve, and there's no buying. But you can see AG, Fortuna, Franco Nevada. This Goldfields is showing actually kind of weak volume, but it's having one of the better rallies among most of the names in the group. In fact, the only one rallying more sharply is my other favorite, AG, First Majestic. So here we go. Now we're rolling back the other way. So there it is. That's probably the end of it, Chris. So here you have the, let's look at the UVXY. You notice the dollar's trying to turn back up. Yeah, UVXY is just starting to cross. I kind of anticipated this, though, because you got the flattening here, and you've come down for a ways. So, yeah, I figure if this is going to be like low risk area to get in, and then we'll just see if we get a big pop. So far, so good. Knock wood. So, anyways, what else? Where are we? Let's see. Back.
Also, if you look at the FANG stocks with Microsoft,
Okay.
they've just been bouncing along on very unconvincing volume. So it's not the kind of constructive like rounding out that you would normally see. And some of them aren't even trying to round out. They're still in downtrends like AMD. So it's not looking positive whatsoever. You know, and when you look at Tesla, I mean it's deconstructive rather than constructive. So it just seems like on the weekly too, that's very revealing. It looks to me like it's slop and chop from which new uptrends are not born. So yeah, I think we have another down leg in the offing. It's just a question of I guess when the shorts get cleared out, because there's probably a lot of heavy short interest going on. That was starting today.
And you can see on Tesla, for example, you're really just in a bear flag. So you can see this right here. Actually, you know what? Let me do something real quick. I'm just going to, that's not it. I want to make the bars just a pinch larger. So, and I'll do that with volume. Easier to see for everybody. And you can see the bear flag here in Tesla, and I bet you most of the other, if we cruise through a lot of these patterns, you see the same thing, Qualcomm, Oracle, and these are all the big stock NASDAQ names, so I'm just going to blow that a little bit. Netflix, that's a bear flag. Wow, this is interesting. Heading south now in a hurry. Microsoft looks like it's ready to break out through a bear flag. If you look at the daily chart here, you had a short entry at the 50-day line. And that's Microsoft. You know, what was that due to, Chris? That was wasn't it news that PC sales have plummeted?
Yeah, that's right.
So here's Meta Platforms. Okay, Meta and Netflix supposedly are now value stocks. Okay, but what does that tell you? When you have a stock like Meta Platforms or Netflix, which at one time garnered huge PE expansions, now all of a sudden they're selling at 20 times trailing 12. That's not a value. What it's telling you is that the marketplace is much less value on the forward earnings stream of these companies for good reason. So, you know, that's why if you look at something, I'm just going to segue real quickly. For those of you who follow me on Twitter, I did post this pattern. U.S. Steel, when it topped, it actually topped here in a late stage failed base. So you had a short 3-4 week base here, and then when you failed, it busted hard, and it's gone straight down. But the PE at the time that it broke here was 2. Okay, yeah, it was 2. Guess what the PE is now? It's 1. So what does that tell you? Was X of value at 2X earnings? No. It's just telling you, man, the market does not like this company. So here goes. All right, so now we're rolling back. My UVXY is doing a little better, but again, I'm not going to put it in the bank. Somebody says, if you case Schiller index in place of owner equivalent rents and CPI inflation is closer to 13. Well, yeah, we know that. But also, if you simply use the methodology that the government used in the 1980s, so they're running around saying we're at a 40-year high in inflation. But the reality is we were at a 40-year high in inflation a while ago, because if you use the same methodology that the government used to calculate inflation in 1980, you're way above 40 years ago. You're somewhere north of 20%. So, you know, it's all BS, and it's like, you know, liars, figures never lie, but liars always figure. In any case, I just want to make that point about here we go, about low PEs and meta platforms and whatnot. So let's see, where are we? We're just cruising through. Apple's in a bear flag. Okay. Cisco in a bear flag. Microsoft, I said Netflix, another value stock. And that's that. So what else are you looking at, Chris? Oh, semiconductors. Let's look at some of the big stock semis. So this is them today. They're trying to rally. But if you look at the weekly charts over here on the left side, where's AMD? It's just hanging along here. It's trying to find some support along this base way over here on the left side. But, you know, chip demand has plummeted. There's now a glut of chips out there. And so, you know, the chip shortage, what happened? It's gone nowhere. Anyways, what are we down? We're down 200 on the Dow. Nasdaq's hanging in there pretty well. It's only down 18, 19. But again, these patterns, you know, they look to me like, yeah, you could rally back to the highs and then just roll over. M-chip. I mean, the whole group is basically in a bear flag. So if you rally to the highs, say, if we look at, say, the SMH, which I used to track, I track the 12 biggest semiconductor names or something like that, because those are the biggest components on the SMH and also the SOX S, which I like to use as a vehicle for the short side if I want to short semis, and the SOX L if I want to go long semis. If you look at the SOX S, you got some of these names rallying, so they're pushing it into the 20-day line, but you might watch it on the 620 chart because you're just starting to get a cross here. And so that might be heading back the other way. So anyways, AMD looking at like a short. Well, as I said, as I'm saying right now, I mean, these, you can see you have here you have a MACD cross. So on the base of the 620 chart, you have the MACD cross, you break the 6-period line here, see if the 20-period line holds up as an intraday support. If not, then yeah, it's definitely a short. But again, you know, you're going to notice if I cycle through some of these names, so let's just go through, you know, then look at the 620 chart. So MU looks a little bit like AMD. Let's look at M-chip. Looks a little like AMD. They're all rising and rolling together, okay? So you can kind of avoid the headline risk and just go after a short on the SMH via the SOXS. So, and you have a 620 buy signal here on the MACD cross. If it doesn't hold, it's pushing through the 20-period line as we speak, or as I speak, and hanging in there. So we'll see whether that's resistance or it can clear that decisively. But, you know, that's how I would play it. And that's how I do play it. So stick with the ETFs to kind of take you out of the realm of headline risk with individual names. And if we look at, let's see if I can back away here. Let's look at infinite PE stocks. So I look at some of these, and some of these might be rallying into juicy areas. You see this Chewy is pushing up towards the 200-day line. Teladoc. Some of these you could track. You know, Big C is actually an e-commerce play. Twilio, they're pushing up into potential resistance. I guess the idea being that if the Fed is close to reversing course, then these high PE or infinite PE stocks in many cases are suddenly going to go higher. I'm not really convinced of that. I think they've got some issues. If they're not making any money, nobody's going to love them if we head into a bad recession. So anyways, so some basic ideas on what is essentially a very confusing day. But I think there are ways to play it. I would definitely be tracking the various inverse ETFs. You can track the VIX using this. You just got a buy signal on the MACD cross. You can track the S&P, which is just starting to look like it wants to cross. Looks a lot like the SOX S. And that's actually pushed right through now. So it's actually improved since I last looked at it. You can see the SQQQ now is flashing a long entry signal. And I think for the most part, you know, if you're looking at something like this, the risk is relatively low. If it fails, it's going to drop through. The MACDs are going to reverse, and you're going to run into resistance at the 20-period line first. So if it can get past it, so what I would be looking for here on any of these would be the cross here, and then I want to see it get past the 20-period line and stay there. Okay, then I'm a little bit more comfortable, maybe even averaging up on little pullbacks to the 20-period line. But I think it's going to be touch and go. But now we're starting to roll over a little bit more earnestly. So this could be very timely and a good way to end this webinar. Anyways, that's all I've got, Chris. You got anything else?
I'll just leave everyone with, I know that I've had questions about, some of these, crypto heavyweights, and they are crypto heavyweights. In fact, some of these guys have, well, I would not say some. There's one company that has done very well because they're good at doing ICOs and things like that. And the guy who runs it is got a good head on his shoulders. But where we disagree, and I'd say we agree on like 95%, but the 5% we disagree, he, I think, is playing Wall Street, as in he's trying to justify why Bitcoin has to decouple from all of this, from inflation, and that Bitcoin will actually go on its merry way higher and higher over ensuing months, even with high inflation. And my view is it's not inflation per se. I know they say Bitcoin could be an inflation hedge. Eventually. I mean, what is eventually? 2 years from now? 5 years from now? In the meantime, as long as there's less capital flowing into the system and the Fed's tightening, everything is at risk. And so the most at risk are risk on assets, and Bitcoin and crypto are the most risk on assets. So for him to intimate that there could be a decoupling, I think is also a pipe dream. It's just way too wishful thinking. I'm not in a disagreement that we could have a decoupling of Bitcoin away from all of this at some point, but I think that's still a few years off at the minimum. And in the meantime, we're going to see Bitcoin. My call on Bitcoin is it could easily go down to 10,000, if not lower, if the Fed keeps hiking rates. Then Bitcoin is going to see new lows over and over again in this iteration. And, that could mean 5,000 Bitcoin. And what does that mean for the rest of crypto? Well, you can figure that out. Everyone can figure out what a bloodbath that would be. And 2018 was a horrible year for people in crypto. It was absolutely devastating, but we didn't have the inflationary conditions we have today. So arguably, 2022 is going to be worse than 2018, which means that Bitcoin, if it drops as much as it did in 2018, that would put it at 10,600. And I think it's not going to stop there. We're going to go worse, but we'll see. We'll have to see how it all plays out. It's going to come down to what the Fed does. So, keep your eyes peeled to any intimation that they're going to start halting the rate hikes. But I think that there's going to be at least 2 more mega rate hikes in the offing before they can even suggest such a thing.
Yeah.
So.
All right, good enough. Anyways, everyone, thanks for showing up, and good luck. This is going to be a very interesting day. I think we could break for the lows. We'll see. So far, we're starting to do that. So I got some inverse stuff. I'm long. We'll see what happens. I also noticed that the miners I was looking at the beginning of this webinar are starting to roll over. So, for example, First Majestic pushing back through the 724 UNR level on this left side low. And so, it's run into resistance at the 20-day line. So for all we know, some of these just turn into shorts, and then they break out to the downside again. Whoop, I need a black pen. And just kind of like, so for example, this would be a bear flag breakout, and now the move is a pull up into the lows of the bear flag. So that's possible. That's all we're seeing here. Anyways, thanks for showing up. We will talk to you guys next week. Take care.
So long, everyone.